Good morning, Stearns Financial Clients. This is Dennis Stearns. Welcome to our first chat of the coronavirus crisis that is live. Just for everybody's information, this will be recorded and will be available for viewing later. I would ask that if everyone on this chat could turn off their video, and the Q&A, you can use the chat feature, type in any questions that you might have as we go along. And our investment committee, which includes myself, John Thomas, PJ Williams, and Glenn Joyce, are all live mic. Our intent is in about 15 minutes to go into your questions and address as many of them as we can in this 30-minute session. So let's get started. And the first slide that you'll see here is talking about some of the difficulties, the zone of uncertainty that we have. Hey, Bill, yep, there we go. Thank you. And so this is James Bullard, the Federal Reserve Bank of St. Louis president, who a few days ago said this coronavirus crisis is much like a car on the highway coming into a construction zone. Car has to slow down, navigate twists and turns, but there's nothing wrong with the engine, meaning the economic engine. And after you clear the construction zone, you can speed up again. Now, we don't know exactly how long the construction zone will be, but we have some ideas, which we'll talk about in a few minutes. Let's go on. And so here are some other key points from Bullard. He says, this is not a typical recession that we are entering. In his view, it's a self-imposed recession to minimize the impact of the coronavirus. That may seem like a detail in the midst of this storm, but the fact is that I think it's an important detail that we have a bit more control over some of this than in many of the other recessions that we have seen in the past. Although arguably, coronavirus will set its own pace in terms of that control. He does believe the second quarter that we are entering in April will see an unprecedented slowdown in the economy. And we do believe, you will all see in the poolside chat that you'll receive later today, we do believe the quarter that's coming up will be historical in terms of the downdraft in economic activity and unemployment. Many businesses will be back operating in July. Again, this is Bullard's opinion, and others will have to wait until August or later as the virus slowly subsides around the US. And he believes that by October, the pent-up demand could create a fourth quarter boom that will be significant. Next slide. So here's the puzzle that we're dealing with here. And we're calling it a 3x3 layer puzzle. It's actually even more complex than this. But the three major layers, the coronavirus itself, there is a very good chance that as infections move up in the next 2 to 4 to 6 weeks, and we are already the leader in the world, as you may have seen yesterday, in infections. As those infections move up to the top end of this curve, we could see that peaking in 4 to 6 weeks from now, and then gradually moving down the other side of the curve. We're watching the real-time experiments going on in China and Italy, and this seems to be the pattern. And as we'll see in a second, the pattern is a little more complicated for the US perhaps, but then we see those infections move down over time. US economy in the meantime, sharp contraction as we show here, somewhat coinciding with the tick up in coronavirus, again, at our own choosing. of trying to shelter in place. And then on the bottom chart, US stocks already have taken a sharp contraction. And I know that all of our longtime clients and readers of our chats know that the stock market does tend to uh, bottom in advance of crises and then start to recover even while the crisis is still underway. We'll look at some historical notes on that in a little bit. And so the US stock market, again, we have the potential that it is beginning to recover before the top two are actually showing recovery. And so it is a very good reminder for everyone that historically the US stock market has done best when we go from bad to a little less bad. Now, again, all of us would like to wait until it goes to neutral or all flags flying green, all clear. And unfortunately, the stock market doesn't behave that way. It usually, by the time all flags are flying green, the stock market has already gone up quite a bit. So that's the tricky part here. And again, you'll see more detail in our poolside chat coming out later today. But we're still generally taking this on a case by case basis. Some of our clients are better able to ride the storm out than others. Some need to raise cash, some need to protect assets, like not only their own assets, maybe those involving a business. Some of them have children that need supporting. So, you know, we have a general game plan, but then we're doing specific strategies for each of our clients' unique circumstances. Next slide. So this gets into what we call the zones of uncertainty. And so up on the top, the coronavirus zones of uncertainty, the 4 blue arrows just represent the fact that this is not going to be a monolithic recovery in our country. Some parts of our country, Seattle in particular, got hit hard first. New York is now one of the major epicenters, and it will roll sector by sector, state by state, community by community. And so there will be rolling recoveries in each part of the country. Some of those parts of the country are dealing with their own issues unrelated to coronavirus, most notably Texas, where the oil decline as a result of the essentially spat going on between the Saudis and the Russians, both of which would like to see our oil industry not as robust going forward. That could last for a while. And so they've got their own overlay of issues in addition to coronavirus. And then on the coronavirus on the far right, you see that arrow moving up. That's the possibility that we could see a rebound in coronavirus cases. Again, we are watching a real-time experiment going on in China as they restart the economy. People start to go back to normal times. And in that situation, those normal times, we will see if coronavirus comes roaring back or comes back a little or comes back not at all. The US economy, the chart in the middle, what this represents, these 4 different arrows, is the fact that there will be parts of our economy that snap back much faster, and there will be parts like the bottom arrow that take a long time to snap back. You know, one of the interesting nuances of this major rescue bill coming out of the US government this week is that many of the cruise lines are not based in the US and will not be benefited by this $2 trillion rescue package. And it's also arguably hard to know how quickly people are going to want to get back on cruise ships, even after the coronavirus has become a bit of a memory. So there are some industries that are going to take longer to recover, some that will snap back quicker. And then finally, US stocks on the bottom, same thing is true of US stocks. There are some that will show almost a V-shaped recovery as the signs of the easing of the coronavirus and the restart of the US economy happen. There are some, as evidenced by the bottom arrows, that may take quite a bit longer to get back to normal. Again, a lot more texture will be included in the poolside chat this afternoon. Next slide, please. And so here's one of the things that has probably taken the worst case scenarios off the table, in our opinion, and that is the government intervention. Now, what you're looking at on the screen is a comparison of what the US government did for fiscal stimulus in the Great Recession in 2008, which was $800 billion, 5.5% representative of the economy size at that time. Compared to today, we're talking a $2 trillion stimulus, which is 9.3% of the economy. And those numbers, 2 trillion and 9.3% of the economy, are historical. Now, you could argue that as a percent of the economy, some of the things that were done during the Second World War were also pretty high. But this is a fairly significant intervention, and it comes right on top of the Federal Reserve, all the different things that we listed in our last poolside chat. And then since then, the Federal Reserve has said, okay, we're all in, and we're going to backstop US banking system and anything else that's under our purview to the full extent we can. That is unprecedented. So the combination of the two will take some of the sting out of the really bad economic news we're about to have in April and May, which, by the way, pretty much April and May, every day, you will see shocking headlines, and it will be historical headlines. Well, that is true. However, this stimulus, I think, will cushion the effect for certain industries. Other parts of our economy, maybe not cushion quite as much. Next slide. So we've had a lot of clients who have asked the question, what do we think is the real likelihood that we're going to figure out antivirals and vaccines and those sorts of things? Well, you know, we will certainly leave some of this up to our medical friends, and we are tied into a lot of people in the pandemic world, including researchers and others. But this is just a short list of some of the things that are being worked on. And so what we are hearing from most of our network on the infectious disease side, many of whom are skeptics about how quickly things can happen, is that there is just an awful lot going on, that it is probable that we are going to see some of the treatments for this disease, which are already underway. I call your attention on the left-hand side to Gilead's remdesivir, I think is how you pronounce that. And that was mentioned by one of our infectious disease experts as pretty interesting, but there's also a lot of other really interesting things going on in this world. And so I think this is an overlay that possibly also lowers the risk of some kind of major issues as we get out 6 months to a year from now with coronavirus. Next slide. So this is getting to the economic side and how far do earnings fall in a recession. This particular chart is showing both reported earnings and operating earnings of companies in the S&P 500. And the distinction in those two is that reported earnings, companies take opportunities, crises like this, to write down a lot of assets. And so that's where the blue may go lower than the actual operating earnings. And so we do expect the operating earnings in this 2020 second quarter, essentially gear down of many parts of our economy, to be pretty significant and rivaling anything on this chart. Again, I would take with a grain of salt anything prior to 1930, back into the 1800s. And so while it will be significantly difficult this particular quarter, let's go to the next slide. The potential rebound, time to regain prior peak, is probably also going to be significantly faster than historical. And so this chart is a little busy, but it's talking about the every earnings decline we've had. And again, it goes back to 1876. And I would probably discount 1894 a little bit, but every earnings decline that has been greater than 15% in our country. And what we see here is the amount of time to regain the prior peak in gold. And generally, except for things like the Great Depression, generally it's been something in the 3 to 4 year range of time to recover earnings back to where they were. And that is pretty significant in terms of thinking through a lot of the companies and the fact that the decline in this bear market has been unprecedented in terms of the speed, but some of the recovery may surprise us in terms of how quickly it happens. Again, it's going to be company by company, sector by sector, because there's some sectors and companies that we're not sure will recover very quickly. Next slide. And so this actually really gets to the hub of it, the fact that in past issues, the Great Depression, savings and loan crisis, and then the financial crisis of 08-09, the Great Recession. In each case, the gold line are cumulative bank failures, and you see the stock market represented by both the Dow back in the Great Depression and the S&P 500 in the savings and loan crisis, and then the financial crisis of 08-09. You can see the stock market actually begins to recover well before the failures actually peak. And again, that's pretty typical that the stock market is looking ahead and looking for signs that there will be better times ahead. And so again, I think we will see that pattern play out, just like we saw the stock market react violently to what we're about to enter in April and May. Next slide. So that's it for our main remarks. Again, there will be a lot more texture in this afternoon's poolside chat. I'd now like to open it up to John, JT, Glenn, and PJ, and handle some of your questions. So, one question that I think is an important one is we covered it a little bit in the early part of this chat, but what is it that we're trying to do in terms of strategy for our growth clients versus our growth and income? PJ, you want to start off with that one?
Yeah, happy to, Dennis. So I think, we've kind of bifurcated our clients among those two sides. Those that are really focused on growth and are willing to take the risk that
PJ, you may still be on mute.
we have another drawdown. So yeah, as I was saying, we've bifurcated our clients, looking at them both from a growth perspective and a growth in income, with the expectations on the growth side. We're going to be more willing to take opportunities as the market has fallen to begin nibbling and adding back risk. So if the market does turn around from this nice rebound we've had the last 5 days, we will take more opportunities to continue to add some risk for the growth clients. we're going to be more patient with the growth and income clients, knowing that for many of these clients, they might be living off their portfolios and not wanting to ride out the full storm. And so in those portfolios over the last couple of years, we've really built in a lot of diversification. Beyond equities, we have fixed income. We are holding a decent amount of cash. We've also been adding real assets, which we think are going to add value over the long term for those portfolios and keep them very diversified from not taking the full brunt of this stock market decline. So with those growth and income clients, I think the key is that at this time, and given what we've looked at with the data and trying to follow the virus and where it's going, we're willing to be more patient on the growth and income side.
Well, this is Glenn Joyce. I just will add on to PJ's comments. I know we're having a little technical difficulty, so apologize for that. I think one of the things that's important right now is to really understand your strategy that you're in and make sure you just feel good it's appropriate. I think right now diversification is working, and I think you just want to make sure that you understand how we're trying to address both the growth clients as well as the growth and income clients, because the strategy is different as PJ described. And right now we're trying to figure out, the markets are very volatile. This is unprecedented. And so we're just trying to best navigate this and think both on the risk side as well as the opportunity side. And so I think getting back to that strategy piece, it really is important to understand kind of where you are, if it is still appropriate. And by all means, call us if you have questions. We're happy to talk through it. I think that's very important right now, is having dialogue with clients. I think, you can look at it from both perspectives. Generally, if you have a long time perspective, you generally have the wherewithal to take more risk and look across the valley. Near term, it's very uncertain, where the market's heading. So I think, making sure you're talking to your advisor, give us a call. We want to make sure that we understand kind of what you're seeing, but also we want to just hopefully keep risk levels down, keep everybody emotions in check, and just try to think rational, but really consider everybody's individual circumstances, because as Dennis described before, sometimes it's more of a one size fits one, and considering each person's individual circumstances. So I'll pause there and give somebody else an opportunity to expand further.
Well, so I think a follow-up question to that, Glenn, is several folks want to know about structural damage. And there's a belief that there has to be, even if we're doing this recession of our own choosing, effectively, there's got to be structural damage to the economy, much like there was coming out of the Great Recession. And so who wants to tackle that one?
Dennis, I'm happy to address that.
Go ahead. You, PJ.
I think when we're coming out of this crisis, and again, hoping that will be later this year, you will definitely see a different recovery than what we experienced back following the Great Recession in 08-09. With this one, I expect there to be a wider range of outcomes for different sectors. We know that we're already seeing it, whether it be restaurants, retail, cruise lines, we can name some others. There's going to be a lot of businesses that do not come back from this. We know that. Unfortunately, there'll probably be a lot of small businesses that just are not able to withstand the duration of the lost revenue that they may experience over the coming months. On the other hand, you'll have other companies, whether that be some of the large tech companies, another name like Amazon, other businesses that were well capitalized coming into this. Again, think the bank's recovery from this may be quicker than what we saw coming out of the Great Recession, just because of their capital ratios with some of the regulations that were put on them following the Great Recession. So I think that long term to the U.S. economy, we think that the structural damage will not be as enduring as what we observed coming out of the Great Recession. But we think that there will be some sectors or industries that are hit much harder and may take a lot longer to come back, with businesses within those sectors not returning after the crisis.
And this is Glenn. I'll just add, I think we're going to be reaching a critical decision coming up in the next few weeks or the next month or so. And I think that is, and you've heard some of this already if you're listening to the news, and you've heard a lot of discussion about the cure versus the disease, and kind of the economic impact, like Dennis was describing in the question, versus obviously the health concerns and protecting our loved ones. And I think, weighing those two, obviously some folks are more vulnerable to this than others, but I think that's going to be a key decision and likely a political hot potato sometime soon about when do we start kind of restarting the economy and kind of weighing those risks. And I think that's going to be a key decision, and to try to limit some of the damage. And when that's appropriate, I don't know, but that's going to be something I'm thinking it's going to be a big deal coming up in the next few weeks.
Yeah, Glenn, this is JT. Hopefully folks are able to hear me now. I understand we've gotten a question about, with the recovery being perhaps longer and uneven by sector, might we need to rethink the use of ETFs and other more index tracking tools? I think it's a fair question. Obviously, there's been a huge burgeoning of the use of ETFs and indexes over the last 10 years as we've been in a long bull market. I think that, yes, we want to be thinking, are there sectors that we want to lean into versus taking the broad market exposure, particularly in the volatility we're looking at. ETFs, obviously, there are so many flavors of those. They actually can still be a tool to address specific sectors. The concern about that is, obviously, if you're taking the whole, say, energy sector, you're picking up some of the weaker balance sheets along with the stronger balance sheets. So obviously, in an ideal world, we'd want to be able to sort through those and pick out individual companies. Obviously, you still need to deal with diversification. So I think it's more likely we'll still use some sector-specific kind of rifle shots combined with the use of some of our more global and value managers, that the mutual fund side, who have the ability to spend a lot more time looking into those specific companies and picking between them. So they may be able to lean into the crisis effect a little bit more proactively. Had a next question about what it suggests for folks who are maybe landlords, maybe having tenants that may be struggling through this crisis, and how do they handle the moral concerns with folks who may be unable to pay rent. And that is really getting at the crux of one of the key issues for the economy. Is we've gone into this pause, this suspended animation. I believe it's one of the Fed governors referred to it as a timeout. And, in a timeout, you want to stop the clock. You want everybody to get to huddle and figure out their next play, and then you want to resume the action. And we have this kind of trickle down or trickle up, depending on where you are in the chain of, are you going to be impacted? How can you manage the impact on others and not be, just like in the virus, you don't want to be sharing that virus or that contagion with others up the chain. So that's going to be a real dilemma for folks who have to make the tough decisions about enforcing legal requirements for rent. I know many states and even perhaps municipalities are either stepping in or perhaps negotiating with mortgage holders. Obviously, those landlords who are more exposed on their own balance sheet are more contingent. They have to meet their own obligations. So how much leniency can they provide and still honor the terms of what they've borrowed? Again, the hope is the fiscal package quickly alleviates a lot of that strain and provides a bit of a bridge loan to many sectors of the economy, both large and small, landlords, employers, et cetera, so that they can provide that 2 to 3 month window of time before we begin to have more of a compounding of the debt problems. Hopefully we can address that. If I may, I think one of the pivotal questions on so many folks' mind is, we've had a pretty nice bounce back this week, a lot of that contingent on the fiscal package coming through. Obviously, that's still in some debate in the House, but presumably that's going to get passed. As Dennis referred to earlier, the Federal Reserve steps were very meaningful that hopefully forestall the worst case scenarios. Obviously, no one knows exactly how the virus, the medical side, is going to develop. Still hopeful that the early success from some of the Asian economies about being able to quell the new cases as they have that lockdown take effect over a few weeks, that will begin to show success in the Western democracies. Obviously, Italy is one of the most pivotal ones that is still lagging in the ability to turn that tide. But I think once we begin to see that tide is turning, that will be an important signal to the overall markets. Though again, the U.S. may be one of the slower ones to accomplish that turn. So with this nice bounce back that we've seen this week, I don't think anyone can really be very confident as to whether the next move is plus 20% or down 20%. But if you're able to look out, say, 6 months to a year to 2 years, very likely that the vast majority of the companies that we own through portfolios are going to get back to providing vital goods and services to customers at a profit, and their stock prices will reflect that. So just as the record highs in February might have been a little bit artificial and inflated, very likely 6 months to 2 years out, when we look back, we'll hopefully see that the lows that we've seen earlier this week were also a bit artificially deflated. But it's going to be a choppy road over the next couple of months, though again, our base case would still lean towards there being a pretty meaningful recovery in the second half of the year. And broadly speaking, we want to make sure that our clients get to participate in that recovery. Though, as several folks have indicated, we do want to be very attentive to customize our approach to specific circumstances for each client.
Thank you, JT. And we had said that we were going to try to keep this to about 30 minutes, and we're a little bit over that now, but we appreciate your feedback and your questions, and we will make sure that we continue to incorporate these chats for probably at least the next 8 weeks. We will be having an 11 a.m. chat talking about investments and financial planning and your questions. And then our 4 p.m. chat this afternoon kicks that off as well with Dr. Gary Brott. Many of you have heard him before. He is excellent. He is in demand all over the world on how to deal with discontinuous change and anxiety. And so we are in the midst of that. And then every week we will also have a 4 o'clock special guest on a whole variety of topics that are helpful. So give us your feedback on anything that you think would be good things to cover, either in these 11 a.m. chats or in the 4 p.m. chats that we have every Friday. Thank you. And on behalf of our entire team, hope you stay safe, do well, and look forward to talking to you soon. Thank you.